Good morning, everybody. Thank you all for being here, both in person and on Zoom. My name is Caleb Baldwin. I am the president of investment sales at the real estate shop. We do a lot of commercial valuations and brokerage as well. I have extensive experience in commercial real estate and investment-based real estate. Going back to 10 years ago, I started when I was 20. Got started in the property management world and small level development before getting some exposure to the appraisal industry. And then over the last 5 years, been heavily concentrated in helping people buy and sell and strategically own and operate their multifamily apartment buildings. So that's what we're going to talk about today. The state of the market, where it's headed, and what to expect for the remainder of 2026. We'll talk about LA County, we'll talk about Orange County, how that impacts tenants. We'll talk about how to strategically position yourself as a housing provider to relieve stress and have the most level of success as possible for the rest of the year. So here's a quick little overview of what we'll talk about. We'll go over the current economic snapshot, so from a lending perspective and from a high-level economic perspective. Before we jump into LA County multifamily, Orange County multifamily, we'll look at some of the historical trends and projections for the remainder of this year and into early next year. And then, of course, what we're all here for is why is this important, why should you care, and how can you plan accordingly moving forward. So as we look at the lending and economic snapshot, some of the most important things that we get asked on a regular basis is what are interest rates looking like? Where have they been? Where can we expect them to go? And as a result of that, also the other economic trends such as inflation, employment trends, and what that means for you as a multifamily housing provider or somebody that is a stakeholder in that industry. So whether you're in the business itself or you have an auxiliary service, this is all super important stuff so that you have an idea of what to expect. So let's show me the money if you are a Jerry Maguire fan out there. So here's a quick snapshot. This is the federal funds rate. As most of you probably know, the rate that the consumer ends up taking out when they get a loan is about 2 to 3% higher than what the Fed is, and you'll see this on the next slide. But as of right now, we are at 3.64% at the funds rate, and so that will take me to what you'll get as the consumer on the next slide. But one thing I want to point out from this chart here is there's clearly an outlier. If you look at 2020 to 2022, I think we can all acknowledge and recognize that rates were drastically lower than we've ever seen them and probably lower than we'll ever see them again. And when you get to mid-2023, we see a huge peak. Thankfully for people that are borrowing or recapitalizing, refinancing in the current market, that has come down a bit, again, to that 3.64 number. And like I said, you're typically 2 to 3% higher when you do finalize that loan. And so this is the current average for multifamily interest rates. This is sourced across all lenders, so whether it be a bank, whether it be a private lender, and as most of you know, your best rate is going to be the shortest fixed term, which is your 5-year term, and then it trickles up with the 7-year and the 10 years. So, but all in all, it's a pretty tight spread. You're looking at between 6 to 6.5, obviously subject to good credit. If you have a portfolio loan, you might be on the lower end of this, closer to 6. And if you're looking for stability and a rate that's fixed for a longer term, then you could expect to pay around 0.5% higher in terms of the interest rate. So I want to unpack this on this slide and the next. So this is the CPI. This is what they call the Consumer Price Index. Some of you might have heard the term the basket of goods. So these are the most common goods that consumers spend their money on. As you can see, it's been pretty stable since the beginning of last year until now. We're at around the 3% mark. And we'll get into why this is important on the next slide. But again, you can see it's stable. In the short term, prices are up almost 1% over the last month. And they're up 3% from a year ago. And I'm sure you're wondering why that matters. And that is because with AB 1482, which is California's statewide rent control, also known as the Tenant Protections Act, that caps what you can raise your apartment rents. So I know that's always a big important question for owners and tenants alike. What can me as a housing provider or the person providing my housing raise my rent in a 12-month span? So I've highlighted April 2025, which is 3%, and the CPI rule is 5% plus CPI equals the maximum allowable increase. So for most of LA and Orange County, if not all, you're going to be capped at 8% until April of next year when the new CPI comes out. So definitely something to keep your eye on, but as you can see, it's fluctuating between 3 and 3.5 since April of last year, and as of January last month, we're also at 3%. So far it's been pretty easy to anticipate, but definitely something to keep your eye on as the year continues and we approach April, if you want to gear up to get ready and make sure that you're staying within the legally permissible amount of rent increases. So as we get into LA and Orange County specifics, I'll run through this quickly. A lot of this will be obvious, as I'm sure most of you have either were born and raised here or live here, but just a snapshot of LA County. So we are the second largest economy in the United States. We have highly diversified employment. One thing that stands out to me in terms of the employment category is aerospace. So anyone, if you're in and around Long Beach, you know how much that sector has taken off in the last several years. You have SpaceX, you have Rocket Lab, you have Virgin Orbit. So there's some really cool employment providers that are coming to the area. As you're familiar with, we have a huge port. There's also great universities and educational opportunities which also drive employment in the area. And then we do have something really exciting to look forward to in the next couple years, which is the 2028 Olympics. I know Long Beach, I believe, has 12 events, so it will be interesting to see how that impacts housing prices, rental rates, et cetera, in the near future. Some things that maybe aren't as strong would be the fact that a lot of people have relocated to cheaper areas. So we do see a slight exodus of population leaving the area for lower price markets and more affordable areas. The high cost of living is obviously a huge component of that. In LA, we obviously pride ourselves on the entertainment sector, so that's been quite volatile over the last several years, especially as entertainment and consumption has shifted more to kind of a streaming service platform. And then obviously, tariffs play a big role on what happens at some of these major employment centers like the port. And as everyone knows and probably still feels heavy on their heart, the wildfire and what that's done has definitely caused a disruption. There's people that are still fighting insurance claims. There's barriers to entry when it comes to redeveloping in those areas that were hit really heavily. So that's definitely something that's weakened our entire area as a whole. Quickly going through Orange County, you also have a large diversity in the employment base. You definitely have strength in the professional and hospitality sectors. If you're familiar with staycations, Orange County is a tough place to leave, so might as well take advantage of one of those strengths while you're here. Tight labor market, so you do have lower unemployment relative to some other areas in California. Definitely some major institutional anchors, so Disneyland is huge, obviously some great universities in the UC system. And then there is a growing biotech and medical component to that workforce. Some of the weaknesses of Orange County, you have slower employment growth versus the national average, so it's taken a little bit longer for the job force to rebound. You do have, again, limited labor force expansion, and the pandemic era out-migration, which is the people that left between the beginning of the pandemic until now. Those numbers are relatively higher compared to other parts of the region that are more affordable. And then obviously, being able to get a job is a huge driver. And so there has been some constraints on overall job availability in Orange County. And we always break this down at the apartment association. We talk about, hey, you know, obviously we're focused on the impact it has on us as housing providers. And to me, one of the most surefire ways to keep your finger on the pulse of that is to think about how it impacts your tenants, right? So we all know the phrase, happy wife, happy life. I like to say happy tenant, happy life, right? No one needs plumbing calls in the middle of the night. So when we look at some of the trends, and we'll dive a little deeper into these specific components, but we look at affordability pressure. Obviously, we looked at the inflation index. We looked at the fact that we're hovering around 3%. So tenants are definitely sensitive to the cost of living, and obviously for most people, the biggest expense that they pay every month is their rent or a mortgage if you're fortunate enough to be in the homeownership, but that does remain largely unattainable for most households. When we look at the growth in migration, job growth again has been modest, and the amount of people leaving the area to more affordable areas has certainly played an impact on that growth. And again, tenants are sensitive to rent increases because it's somewhere around 80% of their total monthly expenditures go towards housing. So with everything factored in, when you look at inflation, obviously there's some strain that's being placed on your average tenant. And then when we look at the outlook, renting is obviously the primary option. We all know that interest rates are higher than what we've seen in the last several years. And when you compare that with pricing for just everyday common goods that's reflected in the CPI, we could see that obviously renting has and always will be the primary housing option. So the bottom line is that tenants are more price sensitive now than they have been in the last 5 to 7 years. Obviously, when we came out of the pandemic, we had low interest rates, we had stimulus checks, all things that softened the blow, but that's definitely a thing of the past. And so the rental demand is definitely structurally supported, but we want to be mindful of the situation that tenants are in, because they are, at the end of the day, the end consumer of multifamily housing. So let's jump over to some stats and metrics. I'll try to keep it high level, so I might skim through some of this. I don't want to bore anybody with stats, but it's important to know where we're at relative to where we've been so that we can develop an idea of what the forecast looks like. So we'll start with sales volume in LA County. In 2025, the total volume of multifamily sales was up slightly from 2024, so that's always a good sign. However, we are still well below the 10-year average by about $1 billion annually. So the activity is improving, but we have not yet reached the normalized levels that we're used to in the region. And that's also reflected when we look at the price per unit. So in LA County as a whole, we're averaging around $350,000 a unit, which is always a very easy back-of-the-napkin metric to calculate what your property might be worth. Obviously, if you have a superior asset, it's going to be slightly higher. If you have something that needs a little bit of work, you'll be on the lower end, but 350 is a pretty solid average to hang your hat on. So we are down 15% from the peak in 2021. Obviously, when you go to the bank and you get an interest rate at 3%, that's going to drive the prices up. So we do see about a 15% reduction from that time period. And we have seen 4 years of consecutive price corrections. And I'll get into why that's important, but that's a long run compared to what we're used to. Typically, it's, hey, every year we see a slight uptick, but we are bouncing back from everything that happened near 2021, 2022. Yeah. Yeah, so that's a great question. So
if you have any more questions, sir.
Yeah.
So the question was, how do you define a 3-star versus a 4 and 5 star? So the first thing is going to be the year built and the quality of the construction. So if you have newer properties that are built in the last 5 to 10 years, they're probably going to fall into that 4 to 5 star range. And then location is huge too, right? So obviously we know developers build the product around the demographic that's going to consume it as the renter base. So if you're Orange County, a couple blocks from the beach, built in the last 10 years, you're definitely a 4 or 5 star asset. And then some of the older inventory that's probably, mid 1900s, even up to, 70s, 80s, that's going to be 3 stars and below. But you know, definitely a good question, and I'm glad you asked because you'll see that reflected in some of these other metrics as well. So when we look at cap rates, one thing that's always been obvious is when interest rates go up, investors want a better cap rate. And so to this gentleman's question, you know, we look at 4 and 5 star assets, so call those the premium properties. They're still the lowest compared to older inventory, older properties. But the spread is not that big. Typically we see a larger gap between the two asset classes. And so we do see cap rate expansion is leveling off. As you can see, going from this line here, which is where we're at now, into 2030, experts are predicting that they will remain pretty level across the board. They might compress slightly, and when we say compress, we might see a slight reduction through the remainder of the year, but it'll be minuscule relative to what we saw in the last 5 years. Vacancy is always an important part, and to bring back the 4 and 5 star rating, this is also coupled with what we just talked about, which is the tenant sensitivity to pricing. So whether you're looking to find a more affordable apartment in your submarket or you just leave the area as a whole, those are both tied to affordability, inflation, asking rents, et cetera. So when we look at vacancy rates, you'll see that the area as a whole, LA County, is outperforming the US, but is higher than what you would see in Orange County. And the asset class that's getting hit the hardest are those premium properties. So you have a smaller percentage of people that are willing to pay a premium for a nice property in a nice area because they are, again, price sensitive in the current market. So you see that luxury assets, so those 4 and 5 star assets, are getting hit the hardest with the highest vacancy at 9.6%. And when we say workforce housing, we're looking at that 3 star and below rating. So that's like, call that your typical tenant base that doesn't want to pay the premium. This is a quick snapshot on asking rents. One thing that really stands out to me on this chart, if you look for the last 10 years, we haven't really seen very many dips below that line. So the orange column represents the rent growth. So as you could see, when the pandemic hit, we did see some slight negative rent growth, and we are forecasting the same scenario in about the same level for the next several quarters. We did see a huge spike after the pandemic, which is definitely something to note, but we won't see that level of gain moving forward, as well as, like I said, the slight dip that is reflective of what you saw during the pandemic. So it's something to be mindful of, because when we have good tenants, or we're trying to attract good tenants, you have to be mindful of the pricing to make sure that it makes sense for them, and that if you have a quality tenant that you enjoy having, that takes care of your property, that you retain that tenant as well. Because whether they're a good tenant or somebody that you're hoping leaves, everyone's sensitive to the prices. So definitely something worth, yeah.
Asking versus effective. Would that be, you ask a price and the effective would be a discount?
Correct. So when you're looking at concessions, you might see, we have some property management people in the business. You might see people offering, incentives, concessions, free rent, to try to entice that person to apply and ultimately lease the. So you'll see a slight discrepancy in that, but it's relatively in line with asking. The market tends to be softer when we see a larger difference between those two numbers, meaning what you're asking isn't always what you get, and the spread gets a lot bigger. And also another thing to note here is that, again, with that slight decrease in rent growth, the recovery is probably not going to happen until later this year or early next year.
You have a question online, I believe. Marjorie, you can go ahead and ask your question. You would just have to unmute yourself.
Yeah, it should pop up right now. I think they're bringing in the Zoom participants. Also, we'll email the PowerPoint out to everybody at the end as well. So.
Yeah, I was saying that it's hard for me to read the numbers on these charts online, so I can't read what
Oh,
the
yes,
rent.
we'll go ahead and send out the presentation slides in the recap email, so you'll have a copy of the slides.
Great, thank you.
Thank you.
No problem. Yeah, if anyone has any questions along the way, feel free to chime in as well. I know that, again, we don't want it to be too heavy on the stats without any engaging questions involved as well. This is always a good metric to look at. So, one of the questions I get most often from newer investors particularly is, hey, when I'm looking at a building to purchase, should I be looking at 2 bedrooms, 1 bedrooms, studios? And so this just gives you a quick snapshot of what the rents are like in LA County for each of these unit types. So. This is just the average overall, so with all these charts and all these graphs, right, I wanted to compile my biggest takeaways for the LA County multifamily market. So to start, pricing has reset. It's likely that we've already seen the bottom, and now it's a matter of either staying put or seeing an increase. But values are down from their peak. We've seen the cap rate expansion already happen, and now they've largely stabilized. And the early signs suggest that repricing, again, is near its floor. So we don't think that we'll see a whole lot of fluctuations moving forward. It does seem pretty stable overall. The demand is soft, but it's not broken. So again, we've seen higher vacancy than what we're used to in LA County, but it's still well below the national average. We all know that there's still a housing shortage in the area. And so that does indicate a relative market resilience, especially when you compare it to other pockets of the United States. And again, the 4 and 5 star assets are driving the weakness. So we saw above 9% vacancy for the premium product, whereas the workforce housing, so 3 star and below, seems to be relatively stable and strong. So some of these numbers are skewed by those 4 and 5 star assets. The last 2 takeaways, so supply pressure is peaking. So we have seen recent delivery waves in the last several years. That has since slowed drastically. And so as we see that, the supply balance out with the demand, you should see the asking prices start to stabilize. You'll see vacancies start to stabilize as we start to settle into what I like to call our new normal. But the near-term performance, so for the remainder of 2026, will be modest. Again, we're still in the early phases of the balancing act, if you will. So we'll do a quick high-level overview of Orange County as well, and then when I'm done with Orange County, we'll compare the two with the most common metrics that we look at. So in Orange County, we've seen that the number of transactions has rebounded. So there was 185 multifamily closings in Orange County for 2025. So that was up from 150 in 2024 and 120 in 2023. So we're seeing healthy growth in terms of the number of willing buyers and sellers in the open market, which is always a good symbol for the overall health of the Orange County market. So total volume was down. So if we see transaction count up but total volume down, that means that just the total value of those properties has declined slightly. But I do like to hang my hat more so on the transaction count because those are active market participants, meaning buyers and sellers. And you do see limited large trades. So what that means is these larger buildings, call it 100 plus, most of those seem to be staying put with the current owners, but we saw about 5 transactions over 20 million last year, so that number is relatively down. Yeah.
You mentioned that on the previous slide, 150 in 2024. So it's hard to believe that in Orange County there are only 150 sales.
Yeah, and so this is primarily for 5 units and above.
5 and above.
5 units and above, yeah. And obviously this doesn't factor in off-market transactions and things of that nature. So we look at the Orange County price per unit. So what we see here is that the pricing has remained elevated relative to the national levels, which I don't think is a surprise to anybody listening. We all know that LA and Orange County is and probably always will be higher than the national average. And we're looking at a range between the the mid threes to the low fours on a price per unit basis. The premium products, so the 4 and 5 star asset class, is commanding a premium. So you'll see that range between 430 to 650 unit, again, depending on where it's at, your built, quality of construction. But overall values have stabilized following the correction in the market that we saw around 2022 and 2023. And again, you'll see some similarities in terms of the cap rate. So where we're at right now is we're hovering around 6% United States, and Orange County as a whole is anywhere between low 4s to mid 5s. So, and we'll compare this to LA County as well, because that's always important for investors to kind of build their strategy and decide where they want to allocate their capital and in which market. So we have seen them expand again, but we do see them stabilizing for the years to come. We do think that the peak cap rate has passed and that we'll see them compress slightly before staying pretty much in line for the near future. Vacancy rates, so again, we know that people are price sensitive. We know that they're looking for opportunity costs. Can they find something similar at a better rate? Maybe that's in a different market, different county. But overall, it is well below the national average and definitely tighter and more beneficial for property providers than most major areas in the United States. But again, also in Orange County, as parallel with LA County, the premium properties are much higher than your average property because tenants are ultra sensitive to prices now. So, but the forecast does project that vacancy should remain pretty stable for the quarters to come. So here we're looking at rents in Orange County. So the average across all property types is $2,750 per unit, which is significantly above the U.S. average, about $1,000 more than the average of $1,770. So when people ask me, hey, why is Southern California a good market to invest in, I look at two things. I look at asking rents and I look at vacancy rates. So asking rents are higher, vacancy rates are lower, and that always makes a solid investment. Rent growth is normalized to about 1% to 2% annually. What I will point out here, if we were to look back at the LA County rents, what you don't see here that you saw on the other is anything negative. So you don't see any negative rent growth year over year. Whereas with LA County, we saw that 20 to 2021, we saw slight decreases in rent growth, and the coming quarters are projected to be negative as well. You don't see that reflected in Orange County. So again, we see a steady upward trajectory in the forecast, and that is backed by the tight vacancy and the fewer number of developments under construction. So the supply wave has slowed. As demand catches up, we believe that will be reflected in rent growth, so 1% to 2% per quarter. And here's the same rents by unit type for Orange County. If you were to compare the two, you'll see that these are quite a bit higher than LA County. And again, this is for all asset classes, so 3, 4, and 5 star properties. So my 5 key takeaways for Orange County is that the fundamentals of the market remain strong. So you have strong vacancy relative to other markets nearby and national levels. So that helps you predict cash flow. I mean, we all know that when we're analyzing a building, we need to know what our vacancy factor is. So historically, we've been around 3%. We're slightly above that, but we're not near 5 like we are in LA County. Pricing power is moderate, but it's not reversing. So again, we see rent growth normalizing at about 1% to 2%. So we don't forecast any negative rent growth in Orange County, so that's good. And the capital market is selectively active. And so what that means is that even though we're seeing higher transaction counts, the institutional, the big buyers, the developers that are behind some of these projects are very selective in the projects that they decide to take on and the assets that they acquire. So I always say that that's the big whale, and what they do is always a good indication of investment strategy, because they see the writing on the wall long before most of us do. And so if they're being very selective, that would echo the same sentiment for smaller property owners and housing providers, is just be selective, be extra picky when it comes to securing financing, look at the building and underwrite the asset in a much more stringent manner than maybe you have in the past, to make sure that what you end up buying and the financing you secure is favorable to you. So we have seen cap rates reset and stabilize. Again, the correction has already happened, and now we're writing that out to get back to standard levels. But long-term investors maintain confident. We do see a lot of private buyers and 1031 buyers accepting lower initial yields, so lower cap rates in premium areas. And it does reflect strong confidence in future rent growth, specifically in Orange County, because we know that LA County, we will see those soften slightly. But overall, the confidence remains strong and stable. So let's compare the two, right? Let's look at LA County, let's look at Orange County. So when we look at the metrics that are important to housing providers and investors, we see that LA County is about 1.5% higher in terms of vacancy. And we know that lower vacancy is always beneficial. So that's reflected as well in the rent growth. So you see very modest rent growth in LA County compared to Orange County, which is stabilized. And we look at luxury performance. So again, those are the 4, the 5-star assets. We see elevated vacancy across the board, while the premium product in Orange County is much more stable than it is in LA County. When we look at cap rates, the spread isn't that big. You know, you have 4.4 in Orange County relative to 5% in LA. That just means that your typical investor is going to want a slightly better return in LA County due to some of these other metrics that we look at. So vacancy, rent growth, you know, that's deemed a little bit more risky, so they want a higher return. With Orange County being a little bit more stable, there's more confidence, so investors are willing to accept a slightly lower cap rate or return on their investment. And then pricing, you do have a big range, but those are pretty much in line, with LA County being more in a recovery phase, and Orange County is stable overall when you look at the fundamental metrics. So when we look at all of those things and factor all of those things in, the 3 big components are that the reset phase is ending or has ended. We've seen prices correct and cap rates stabilize, which helps predict where we're headed. That coupled with construction that has shrank across both counties, so the supply wave is over, and the supply pressure will likely peak before the recovery of demand starts. But overall, we're seeing a stabilization across the board. When we look at Orange County, we see more stability. We see more of a premium on the long term. So you have tighter vacancy, you have steady rent growth, which again, as an investor, you see stability, you see confidence, you're willing to accept a lower cap rate. And that's ideal for long-term holds, asset preservation, you know, retaining the wealth that you've already created through ownership. And then we jump over to LA, we look at selective opportunities. So you have higher vacancies in the luxury assets, but the pricing reset does create opportunities for investors that are looking to possibly gain a higher yield. So if you're selective with the acquisition, you have opportunities that exist in LA County that likely are going to be harder to find in Orange County. And when you look at the upside tied to the supply and demand, again, that does factor into some of these economic opportunities when it comes to acquiring new buildings or redeploying capital. If you're in a 1031 exchange, LA County might have some attractiveness to it that you won't find in Orange County, where the stability lies. So when we look at navigating the remainder of 2026, for financing, a capital strategy is going to be at the forefront. So when you have the opportunity to lock in long-term fixed debt, do it, because we don't know, that's one of the more volatile components, right? No one can anticipate what interest rates are doing. The overall sentiment that I'm hearing from my clients that we're seeing out in the market is that they should come down to some degree, or at least remain stable. I don't believe anyone anticipates an increase in the rates. But that being said, it is uncertain, so if you have the chance to lock in your debt, do that. When you're underwriting properties or looking at acquiring a new building, be conservative with your rents and your cap rates, because as we saw, rent growth has slowed, cap rates have stabilized, and those are two huge components when it comes to analyzing a building. And the same goes for people that are valuing their own properties. So be conservative with cap rates, be conservative with your rent estimates. When we look at what this means for owners, strategic ownership and asset positioning is more important now than we've seen it in recent years. So focusing on operational efficiency, going back to the consumer price index chart, we've seen that that's stabilized, but it is still higher. So knowing that your tenants are sensitive to prices, that means that we're also sensitive to prices as housing providers. So, it would be good to go through your operating statements for each building and find where we might find what we call expense leaks. And sometimes it's as small as a water bib that's just been dripping and now your house meter for your water bill is higher. But looking at ways to optimize that and lower overhead as a housing provider operator is important. Number 2 is prioritizing resident retention. So again, happy tenant is a happy life. So if you have a tenant that pays on time, that treats your property with respect, there's an extra emphasis on retaining that tenant, because they're also feeling the price sensitivity, and I'm sure that they're likely looking at other alternatives to save on their costs, as you're doing from an operating standpoint. So prioritizing your resident retention for the ones that you want to keep is definitely something that should be revisited on a call it a 6-month basis to make sure that your tenants are happy and they don't plan to leave. And then protect your occupancy if you do have any premium products. So knowing that tenants are leaving these premium properties in high demand areas, like coastal properties, close to the water, close to amenities, make sure that you protect that occupancy level, because they're also looking for the opportunity to save, right? And if that means moving inland to something that's cheaper, you can guarantee that they're considering that. So sometimes you have to think outside the box to decide how to protect that occupancy level. But sometimes it's as simple as, stopping by with a little handwritten note or a bottle of wine saying, hey, thank you for taking care of my property, and making sure that they feel valued. And for investors, for the remainder of 2026, when you're looking at acquiring property, LA is going to have more opportunities because there is metrics that lead us to indicate that there will be those instances where you might be able to value add. You might be able to find an owner that has a loan coming due, and the property has been operating less than efficiently. So that's an opportunity in LA. If you're looking for, again, asset preservation, to place your capital in a safe market where it's going to hold its value and be a little bit less volatile than something like LA County, then Orange County is definitely the place that you want to be. Again, that's a long-term hold because it's a tighter submarket. And in general, stay patient, as we know that the economy as a whole and real estate prices as a result of that are slow-moving ships. So we know that the rest of the year is in somewhat of a recovery phase. But again, we have seen, for the most part, the reset already happened. So just be patient. Again, be extra diligent when it comes to looking at different opportunities, and be extra conservative when it comes to underwriting acquisition opportunities, and when it comes to forecasting the performance of the properties that you already own. So with that, that's what I have for you today. Again, here's my information. So I want to mention that even though today was obviously heavily focused on the multifamily side, because it is the apartment association after all, the firm that I work with does have experience with triple net. We have experience with office, industrial, at the very least can provide guidance and insight on other asset classes as well. But save my information. I'm always here to provide value first. And so if you have any questions or want to talk about something outside of what we covered today, feel free to reach out. I pride myself on being a source of education and value for everyone that we work with. So.
Do you have anything on San Diego County?
I can certainly pull a similar report for San Diego County as well.
Can you
Yeah.
forward that to me?
Yeah, I'll get your information for sure, and we'll.
A simple presentation.
Yeah, of course. I'd be happy to put that together for you. Okay, okay, cool. Okay, yeah, I'll definitely put something together for you for sure. Okay, so this gentleman said his vacancy factor is 0.002%. So that's a drastic difference, right? Okay.
And 12 months, that's 360. I have 2 months of vacancy.
That's
That's 0.0002%.
so we'll,
Management companies that raise their rents.
so 0.0002% vacancy in San Diego. So we'll put together a report for this guy and we'll get it sent out, and then he'll have apples to apples to apples to compare, right? Awesome. Well, thanks so much everyone on Zoom and in person for being here. Oh, another question online here.
Yes. Thank you for your analysis. But Los Angeles County is a huge place, and I'm wondering if we could drill down on the information about Long Beach and specifically, because that's where you are.
Yeah, absolutely. If there's any other submarkets, so this gentleman here actually asked about San Diego. We can definitely do a deeper dive on any submarket for anyone that's listening. I can put together a very similar report for Long Beach. We could look at, if you have something in Santa Monica, we could look there. I'm happy to tailor a report just like this for whatever market you own your properties in.
Do you have any recommendations about locations throughout the United States that you should look at to invest in?
So the question was, what other areas in the United States should he consider for acquiring property? The easy answer to that is it really depends. And I always say that it depends on where you're at in your ownership phase, right? If you're heavy on growth, then you might want to look here. If you're heavy on capital preservation, asset preservation, you might go somewhere else. Are you in a 1031 exchange? Where are you securing your financing? So those are all factors that we consider when we look at different areas outside of Southern California. But I'd be happy to see where you're at in your timeline and figure out what I think would be the best fit. Because I do have clients that are 1031ing, and they're always asking that question. Whether it's in Salt Lake City, whether it's in Arizona, whether it's in Indianapolis. I mean, we see options across the board, but it does heavily depend on what you're trying to accomplish and where you're at. So. Awesome. Well, thank you so much again, everybody. I look forward to hearing from you if you have any other questions. I've made a note of San Diego and Long Beach. If there's any other submarkets that you'd like me to drill down a little deeper in, feel free to either throw it in the chat or reach out to Francella, and we'll make sure we get that to you. Awesome.
Thank you so much, everyone. Have a great day.